Record to the cloud. Okay, we're recording now. Thanks, Willa.
You're welcome. Okay, I think we're going to get started. I always, I'm very happy when people come on time, and I feel that it's a good thing to do to get started with respect to all of you. So good morning, everyone. This is Getting to Yes Inside the Mind of a Business Lender. I have been a business advisor, but also a commercial lender for a couple of the big banks, Chase and Citibank, as well as a smaller bank, Gold Coast Bank, which became Investors Bank. So I've kind of seen two sides of lending, and I'm going to share some of my insights over the last 10 years. As a commercial lender, I was also a residential lender for 11 years in my past. So I've been a lender really almost all of my career because that's been a part of everything I've ever done, is look at where people are and try to get them to where they want to be. And I'm going to share the insights again about business lending today and how to get loans approved if you're looking for financing. Whoops, I guess I have to go over here. Okay, so let's take just 1 minute to talk about the Small Business Development Center, of which I am a part. And what our mission is to help businesses grow and succeed. We offer free face-to-face and now remote Zoom and on the phone business consulting and training programs like the one you're seeing today. We help people with their business planning, accessing capital, marketing plans, regulatory compliance, technology development, international trade, emergency relief programs, and so much more. So what we do is dedicate our time to learning as much as we can so that we can share it with the small business community and all of you out there. We are sponsored in part by Capital One Bank. We are hosted here at Stony Brook University. We are also a member and partner of the Small Business Administration and, of course, the State University of New York, which is what Stony Brook University is a part of. So let's get started. We're going to talk today and dig into how a lender looks at lending. There's a lot of content. And typically the questions that come up from participants in this workshop are very specific to their individual circumstance. And what we'd like to do is invite you for those one-on-one counseling sessions where we can dig deeper into your particular situation and hopefully answer questions that are more relevant to you specifically. So not going to take a lot of questions, want to get through the content, give you this overview and this deep dive into underwriting, but not get into the weeds, because my goal here is not to make you an underwriter, but rather to give you an idea of how someone looks at your application so that you can be more successful when you put your application together. So typically a business owner throughout the life of a business comes up with reasons why they think they need financing. One is they've had a very successful business and they want to open up another location. It could be that they want to develop their business into a franchise and sell that franchise out to other people, or buy into a franchise that already exists. Maybe they need upgraded systems and equipment. We know technology constantly changes, so people are always looking for that. They may want to work on their website. They need financing for that, maybe a new product line. The big one is commercial real estate. When a seasoned business has their big bucket list, it's always involving commercial real estate where they want to buy a home for the business. And that becomes a part of their business plan that takes them through retirement, because then even if they don't own the business anymore, they can rent the property out to other business owners. Business acquisition is a way to grow and expand a business. And so sometimes an opportunity comes up, a competitor is retiring or going out of business, and you may want to buy them, which is a quick way to expand, but also comes with some drawbacks. So you want to really look at that carefully. And then, of course, starting a business. We deal with a lot of new business owners who want capital to start a business, and that can be challenging. So we want to really talk that through and let people know the reality of finding money to do that. And we'll talk about that more in a few minutes. So this is basically what we call capital expenditures, which is money that it takes to do these projects. Typically, business lending falls into 4 different types of products. The first one, and I call this the introductory lending product, is the business credit card. So when you first start a business, you're using your personal credit card, and everything is kind of based on the personal. Why? Because you're the strength behind the business, and there's no business there to really look at. So most people use their own money and their own credit to get a business up and going. But once the business has a year or so under their belt, they'll want to get their own credit card. So I always relate this to owning, having a family, right? So as a parent, I get married, I have kids. In the beginning, I'm sponsoring them totally. I'm paying for everything off of me. But the goal is that they're going to grow up and become independent of me and start to pay for their own things. Wouldn't that be nice, right? So that's the same thing with a business. When you start it, it's your baby. It's everything that you want. It's your dream. You put everything into it. But the goal is someday that it gets its own credit card and it starts to borrow based on its own strength. And that's the goal of a business as it starts to mature and go forward. So the business credit card is just like a personal credit card, except that it's in business name. It starts to establish a separate credit history for the business. The line of credit is a more formal lending product that works like a credit card, except it has some nuances to it. The line of credit typically at a bank is based on the prime rate plus a margin. So there is a variable interest rate, just like a business credit card. But with that, some banks will require that you pay down that line of credit once a year for maybe 30 days, either pay it down in full or in half. It's supposed to be a temporary kind of line. So it's, if you invoiced a lot of people, they didn't pay you back right away, but you need the money, that's where you'd use a line of credit. Let's say you need to buy inventory, but you haven't sold the inventory yet. So there's going to be a lag between the time you purchase the inventory and the time that you sell it to the public. That lag would be covered by your line of credit. So it goes up and down. People who are seasonal are going to need more money at certain times of the year. So the line of credit is good, but then when the season runs its course, you are expected to pay back the line of credit and then it becomes available to you. Typically, a line of credit is renewable every year. They are going to take a look at some of your financial information again every year to renew the line and see if that's something that they want to continue doing with you. If you max out your line of credit and never pay it down, it's likely that you're not going to be renewed and they may term it out for you. So it's something to, it's a tool and certainly one that's very valuable to business owners, and they take it seriously, and hopefully they get bigger lines as they get more mature. A term loan is what we would think like a car loan, right? It's going to be principal and interest payments over a period of time. It could be a fixed rate, could be an adjustable rate, but basically it's used to buy a fixed asset or a specific thing. So it could be a piece of equipment. It could be acquiring another business. The SBA has term loans. We're not going to get into SBA products here today, but those are typically used for riskier situations. A bank will come in and offer an SBA loan because it carries a guarantee from the federal government that if you default on the loan, they can get their money back through the SBA. So we are very versed in SBA financing, and we could review that with you. But term loans are basically for specific assets that you're going to buy and repay over a number of years with a principal and interest payment. It's very reliable for your cash flow because you know what that payment's going to be month after month after month. So once you qualify, once you get approved, you'll know how to budget for that payment and it doesn't change. Same thing with a commercial mortgage. Commercial mortgages for businesses are similar to a home mortgage, except they don't usually extend out for 30 years. They're typically anywhere from 10 to 25 years. If you're lucky, you get a long fixed rate on that. Many of them are not fixed rates. They may be adjustables. Some of them have balloon payments. So if I say that there's a 10-year term with a 20-year amortization, that means that you basically have payments based on a 20-year mortgage, but after 10 years, you have to pay the mortgage off. So that is a very popular mortgage plan with a lot of the big banks, but you can also get a fixed rate mortgage. Some banks will offer that. The SBA also offers fixed rate mortgages. So that's something that's out there. But these are the 4 types of products that typically businesses are going to fall into. And when you meet with a business banker, they're going to try to figure out the best combination of products or one product that fits the type of thing that you're trying to do. So let's talk about the lending team. I wanted to take a minute to talk about the players involved in the lending process, because sometimes people aren't aware that it's not just the underwriter. So there are key partners. Number 1, of course, it's us. The Small Business Development Center is where a lot of people come first, because we're a free service and we sit with people. We're objective. We don't have any allegiance to one bank or another bank. We're trying to find a way to get the deal done for you. So we're going to evaluate your circumstance and try to point you in the right direction. A lot of people will immediately go into their bank, and that is typically where a lot of the deals are done for business owners. So I'm going to dig deeper into these players, but there's the branch representative, there's the business banker, there's the loan underwriter and the chief credit officer, and there's the loan processor and the servicer. So these are all people that you may hear from or meet along the way. And why do I bring this up? Because these are relationships, and I can't stress enough how important it is to get to know these people. Certainly the bank branch representative and the business banker, because they are going to be your advocate and your spokesperson to the underwriter. So it's really important that you start to develop relationships with branch people. One of the things we learned through the pandemic is and I am a disaster relief specialist, is I would ask them, well, who do you deal with at the branch? And they go, oh, I don't really know anybody. And I go, do you have a business banker that you work with? Nope, don't know anybody. I see somebody when I go in. And that is something I would like to see you think carefully about. You should know the branch manager. If you're working with a branch, they're invested in you as much as you invest in them. So they should know you and your business, and they are in your community. They want to see you succeed. Yes, they're motivated by getting your deposits and taking credit card applications from you, even processing credit cards, but they're very important people. They're partners in what you're trying to do. So look at them as key relationships. Talking about the branch representative, they work at your local branch. It's typically the branch manager or a customer service representative on the floor that is going to talk to you about your lending needs. They're going to talk to you initially about what you're looking for. They'll see how big the request is, and then they will refer you to the appropriate level of banker. Now, obviously, let's take Leslie. If Leslie is in the branch, this is not the first time I want to meet Leslie. I want to go in and go to the teller, stop by the branch manager, introduce myself, let them know who I am, say, hey, I own the business down the street. You know, you're really local and close by. I plan on establishing a relationship with you. A lot of times the bank that you are dealing with is the one that you have for your personal relationship. So they love to hear that people are loyal to them and are growing with them. It really does make a difference if you know these people. So can't say that enough. These people are underappreciated, I guess is the word. So then usually they would send you over to the business banker, or business relationship manager is what they call them. They are focused on a number of businesses in a geographic area. Some of them work only at that branch, but can work in other branches, and can also be completely remote, but they just go out to businesses and talk with business owners. They are specialists in business banking, deposit and lending products. They interview their clients and new clients about the loans that they're looking to get. They will be the ones that give you a checklist of the loan package documents that you need to apply for a loan. And more importantly, they prepare what's called an opportunity memo for the loan underwriter. So they're going to send all of this into the underwriter, and they're going to give them a history and kind of an introduction to your business. So they are very important people that represent you when you go into underwriting. And that's going to help you be more successful if you have a relationship with them and you give them as much information as they need to do a good job representing your business. Let's talk about the loan underwriter. After the package comes in, they are performing what we call due diligence, which is, let me look at this entire picture. Let me track your performance over a number of years. How have you been doing as a business? Let me look at industry averages. How, if you're a restaurant, how are other restaurants doing? What kind of profit should I expect from this company in this industry? There are what they call key ratios, which determine liquidity and different leverage things, debt to income. There's a lot of ratios that they take off of the financial statements that you send them. So the tax returns are really the Bible in underwriting. Anything else that you give them, it could be projections or it could be year-to-date financials, but the tax return is really what they call the Bible, because nothing else matters than what you report to the IRS. So if you are reporting losses year after year after year, that is going to be the trend that they look at. From every year, they're saying, oh, are their sales going up every year? Are they becoming more profitable every year? How are they growing as a company? So be careful about how you present yourself. I know a lot of people still take a lot of cash in their businesses and they don't report it. But sometimes that doesn't help you when you're trying to be bankable and you're trying to get more money to grow your business. Basically, what they're doing is they're analyzing the risk, and underwriting is all about risk. It's not just one factor. There's a lot of different factors that they look at, and we'll talk more about that in a minute. If the underwriter decides that I like this deal, I'm going to write this up and I'm going to send it to my supervisor or a chief credit officer, and he is usually the final approver for a complex loan. So like a commercial mortgage for sure, because those are big investments from the bank. So they're going to have more than one person looking at this. They also establish the bank credit policy, and every bank has a different policy. There are a lot of similarities between the banks, but they have different appetites depending on the type of bank or financial institution. They're looking to have a diverse portfolio. They don't want to have a portfolio of loans that are all from one industry. So they want to have, you know, some medical, maybe a CPA firm, a law firm, a restaurant. They want to spread the risk out over different types of industries. They're going to look at mitigating factors. What's a mitigating factor? Well, you know, if there is something there that doesn't look good or that you're weak in, they may look at something that you're strong in and say, you know what? This guy's kind of new, but look, he's got good deposits. He's got excellent credit. He pays his bills. So that could be a mitigating factor for a weak point. And so the underwriter is going to look for those and write that up when they suggest an approval. The loan processor and the loan servicer, sometimes they're the same person, but sometimes in the bigger banks, these are separate people. But the processor is the one that takes in all the documents and prepares after the loan is approved. They create the loan closing document, checklist of all the things that you'll need in order to close on your loan. There is a loan agreement. There are other closing documents. If you're giving a personal guarantee, there would be a document for that. They will run a title search. Maybe the credit report is something that they will run and give to the underwriter. So they're very close to the underwriting process, but very important people to know about. The servicer is somebody that does the annual loan portfolio management. So if you get a big loan from a bank, they're going to request updated information every year. It's going to be very important that they get your annual tax return after it's filed. They want to make sure that your insurance is paid. These people are really partners with you in the growth of your business. So they want to be in there seeing what's going on, because if a loan defaults, it's usually something that could have been prevented, or there's a trend towards that before things really south. So they want to pick up any red flags that might be happening with the business. Maybe your sales are really going down, you're starting to lose money. They want to get in there at that time and see if they can help, if they can prevent a default. No bank wants a loan to go into default. It's all about trying to stay healthy and keeping it alive. So now let's talk about applying for business financing. There's an old saying, you only get one chance to make a first impression. And I can't really stress this enough. If you get a package, and as a commercial lender, if I got a package from people and it's missing all kinds of stuff, it's the tax return is missing all the schedules, I have to reach out and say, hey, you didn't send me the whole return. You only sent me the first 2 pages. I need the whole return. It's very, very important that you try to present a very thorough view of your business from the time you first apply. You will get questions from an underwriter after you've applied. There will be things that come up that you may need to explain. But that first package should be really complete and thorough, because that's really going to give a good impression. Just like when you apply for a job and you have a resume, you know, if somebody gives you a resume and there's all kinds of typing errors and, you know, it's a 10-page resume or something, you get an impression from that applicant, as opposed to someone who's very quick, concise, gives you what you need, and you can move on. So this is just common sense. But a lot of people, I think, I hear things like, well, what do you need that for? Or why do you need that? Or, you know, I don't have my tax return yet. All of that kind of thing is part of whether or not you're going to be successful going forward. That impression is important. These are people looking at your business. So remember, there's a subjective part of this whole process. There are the facts, there are what they see on your financials, but there's also a feeling about you that's very, very important to relate. So let's look at the loan package. What do they typically want? First of all, they're going to be looking historically. Most lenders are historical lenders, meaning they want to see where you came from to this point. So they're going to look at the 3 past years of your personal tax returns for all owners that own more than 20% in the business. They're also going to request a personal financial statement. And what is that? That is what you own and what you owe. So it's going to list all of your assets. How liquid you are will be determined by the cash and marketable securities that you have. And then you may own your home, and that would be a fixed asset that is illiquid, right? I can't easily sell your home and get my money back. So they're going to look at your strength as a personal borrower. Really, you are standing behind this business. It's your baby and you stand behind it. So they're going to ask for 3 past years of your individual tax returns and a personal financial statement. On the business side, they'll ask for 3 past years on the business side. And you say, well, what if I don't have 3 years? Well, whatever you have is what they're going to take if you're a newer business. Because we're now in October tomorrow, they would ask for a year-to-date income statement and balance sheet. Usually your CPA can help you with this. If you have a good accounting system like QuickBooks, you can just ask for a year-to-date income statement, which is going to be your profit and loss statement for the year, and a balance sheet. If the year has progressed, like I said, and you're later in the year and you haven't filed the tax return yet, that's going to be an important thing, because that shows them the trends of how you're doing this year. We all know that we're coming out of a pandemic. All underwriters are aware that 2020 was a very tough year for a lot of businesses. So they would probably expect to see some sort of a drop, although some businesses did pretty well during the pandemic. Depends on the industry again. But they're going to want to see these 3 past years. What happened before the pandemic? Were you doing really well and then the pandemic impacted you, but now you're starting to pick up again? Or are you still kind of in the cloud of the pandemic and struggling to get back? So those are kind of the things that they're going to be looking at when they look at tax returns, is in addition to preparing what they call spreads, which is putting all the main numbers of your tax returns in and creating a side-by-side comparison of those 3 years. The IRS has a form, it's called a 4506T. I think they're changing the name to a 4506C, but anyway, what that does is it allows the lender to contact the IRS and verify that the tax returns you have provided are indeed the ones that were filed. Believe it or not, some people prepare their own tax returns and they want to look good, so they make it look really good and they give that to the lender. And then the lender goes to the IRS and finds that the transcript from the IRS is totally different than what you gave them, which we definitely do not want to do. Because back to that first impression, that's a killer right there. But that is a standard in all lending. All of the pandemic relief programs required that as well. It's basically a double check to make sure that the information you gave them is the same. And the last thing is a business debt service schedule. This is pretty common. It's going to be basically your debt that falls into the line of a term loan. They're going to ask you, who is the creditor? What was the original amount? What's the current balance? What's the monthly payment? When does it mature? Did you put up any collateral for that loan? We're not talking about your regular expenses here. It would be mostly like loans, leases, any contracts that you have out there, any notes, or loans that you took with other people, whatever. Your picture of your term debt basically is what that falls into. The other part of the loan package is the business plan. And we here at the Small Business Development Center talk a lot about the business plan. We feel it is a very important product that the business owner gets involved in. It's a process of putting this together. But as an underwriter, I can tell you that the executive summary, the first page or first couple pages, will have basically a recap. It's kind of like an elevator pitch, if you know what that is, which is a summary of the opportunity. It gives the reader a quick idea. Who are you? How long have you existed? What are you looking to do? A little bio about the business. Oops, I lost my my light in here, sorry. So this is a way the underwriter can become quickly acquainted with the rest of the plan. And if in some cases, if you're an existing business and you've been around a long time, this may be all they need from you. And remember back when I talked about the business banker writing the opportunity memo, if he has a good executive summary, you have made his job so much easier. You're not putting it in his hands. You're giving him the summary of your business, what you're looking for, how much you're putting in, why you're doing this. You're giving him everything he or she needs to give to the underwriter. The underwriter also writes up an opportunity memo to support the approval of the loan that you're asking for. So this is really where I like to put most of my energy, in that summary, and try to keep it really simple, but thorough. The full business plan will include a company description, a market analysis, like who are you actually selling to, and what's your community look like, the organization and management of your company, which is how many people do you have on staff, who are the key players, how many managers, maybe it's just you, that's fine, that's a quick paragraph. What services or products do you offer? How do you get business? What's your marketing and sales look like? Are you on Facebook? Do you do digital marketing? Social media marketing is a big part of this now. Specifically, what is the funding request? In some situations, you're going to prepare what they call a sources and uses of funds statement. And that says, this is the money I'm planning on getting in. Part of that is the loan you're going to give me. It may be a seller financing might be part of that. But here's my total money that's coming in that I expect to get in, and here is how I'm going to spend it. So it's a page that's kind of like a balance sheet in itself. The amount of money coming in should equal the amount of money going out. But they want to see, how are you planning on spending this money? You're asking us for 300,000, you're putting in 100,000. How are you spending that 400,000? So it would be a detailed breakdown of that. In addition to that, there would be financial projections, which on a startup business or a newer business, they want to know what's going to happen with this business. What do you think you're going to make? And obviously you want to be optimistic, but also realistic. You don't want to be pie in the sky saying, oh, I'm going to make like 150,000 in the first year, unless you really have something to base that on. You want to really kind of figure out, the way I do it is bottoms up. Look at all the expenses that you know, what your rent's going to be, your utilities are going to be. You can get those numbers and put that down, and then kind of back in how much I have to sell to cover my operating expenses. Most businesses, when they first start out, are going to run in the red for 6 to 12 months before they start to see a profit, which is why it's important to have additional capital available to get you through those lean months when you're introducing yourself to your community and or online, that you need to really get your reputation going before you start to make money. The appendix of a business plan is everything else. That would be resumes, any ads that you've done, research or data that supports your plan. Now, a business plan does not have to be a 20 or 30-page document. It's not a thesis or anything like that. I try to make them as quick as possible. So if someone does read through the whole plan, by the end of that plan, they go, you know what? I have a lot of confidence in this person. They really know what they're doing. This looks like a good opportunity. I would like to be a part of that. I think it would be a good thing for my bank to invest in this business. The business also brings more to the bank than just a loan. There would be deposit requirements where, you know, if this bank gives you money, they expect you to have your relationship with them. So they expect to see over time that the money coming into your business is being deposited in the bank. They may also offer to do your credit card processing. They have other cash management tools where, you know, you can pull payments directly from customers or pay people directly. So it's really important to have that relationship with the bank and understand that if they're lending to you, there's more to it than just that loan. They want the relationship. Remember, it's not just about getting the funding. It's about you. It's about clarifying your business idea for yourself and for your business partners. Most people, when they see a business plan, they go, oh my God, there's no way I can write this. So it is a process. It takes some time, but you want to start small. You don't want to overcomplicate things. Just first of all, focus on what your audience needs. If you're doing it to get funding, you know that that underwriter is going to need some information that she can put in her approval memo, like who is this business, that she wants to show that I know who this business is. She's got a lot of support. The branch manager loves her. The business banker loves her. She's involved in the community. I want to help this person get the funding they need. And write what you know and research what you don't. At the Small Business Development Center, we actually have librarians that can pull research for you. It doesn't cost you anything. We can do demographics of the area, especially if you're doing a new location. Just because you're really successful in your first location, you want to know that your new market might be a little bit different. So it's really important to do some research and make sure that you have a good understanding of what you're getting into. I put in here the Equal Credit Opportunity Act. Why? Because you should know that there are lots of regulations out there in banking. One of them is called Regulation B, and it's basically a 30-day rule. So basically, once the application is determined to be complete, meaning you have submitted everything possible to present your business to the underwriter and to the bank or the lender, they actually have 30 days to notify you of a credit decision. This rule also protects applicants from discrimination. It covers the actions of lenders before, during, and after a credit transaction. And the main reason I put this in here is that the more complete you are going into the underwriting, the faster the decision. And I know most people, it's a very tense time when they're waiting for that decision. So when the underwriter reaches out to you with questions, and honestly, there's been a lot of pandemic relief programs where they've had people, the SBA will write to people with questions. And the SBA had a rule that if you did not get back to them in 7 days, they would disregard the application. So it's really, really important to respond quickly and thoroughly. When I was a business relationship manager, I would get on the call with the business owner when they spoke to the underwriter to make sure that everything was understood and went well. And often I would review those questions that came from the underwriter with the business owner so they had an understanding of what the underwriter is really trying to determine here. So there are going to be questions. They're going to ask you, you have to get back to them as quickly as possible. A lot of people also use their CPAs to help them answer any kind of questions that come up with regard to tax returns and financial statements. So let's look at the application process flow. Goes to underwriting. They review the package, they look for missing information. They usually pull up a list of questions as they're going through your documents. It brings up things they want to know more about. They do like a financial analysis. They feed the numbers into a program which gives them all their key ratios. They see whether or not you're looking good based on those ratios, and they decide, yes, I'm going to approve it. I'm going to write it up. And then it's going to go into post-approval, which comes back to that loan processor. It's handed over to her or him, and they are going to reach out to you and say, okay, this is what we're going to need to go to the closing. Or you might be declined, and they're going to send you what they call an adverse action letter. And you should know that usually they hold on to that letter for a few days so that the banker who took your loan application can reach out to you and I guess kind of soften the blow, but basically explain why it was that you were declined and how things could be improved in the future to get you to an approval. So they are important partners, and I don't think declines are necessarily a bad thing, and I'll talk about that in a few minutes, but sometimes they are doing a lot of due diligence that maybe you should do as well if you're considering a big investment. And if it looks like there's a lot of questions and it's not a strong move, they will tell you that by not participating in this process with you. And you might also want to take that information and say, maybe it isn't a good time. It's all about timing and opportunity. So sometimes the timing, it feels right, but the opportunity isn't there. Sometimes the opportunity is there and the timing isn't right, but that's kind of how it goes. And it's not meant to be punitive in any way. It's really a risk analysis of the opportunity. And it's a good thing for you to look at as well. So let's talk about commercial loan underwriting even further, which is, this is where we reveal the truth, right? We evaluate the applicant's honesty and creditworthiness. This helps the lender determine the level of risk involved in providing funds to you. And again, it's performing that due diligence. They're doing their homework on you and on the lending opportunity. It's basically a risk thing that they are talking about here. They want to reduce the risk. Maybe they want another guarantor. Maybe they want more money down in order to do it. They might transfer the risk by asking for collateral. They may accept the risk because maybe there's some risk, but there are a lot of mitigating factors and they think it's a good deal to do anyway. Or they may avoid the risk altogether and not approve the loan. That could be also because they have no appetite for this particular type of transaction. All banks have what we call an appetite, which is, do they want to do a lot of loans? Maybe this year they took a lot of restaurants and they're looking at their loan portfolio and saying, you know what, we're very heavily concentrated in this particular industry, so we're going to hold back on lending to restaurants for a while. It's more really about your situation in the full picture than anything else. The industry part is a part of the picture, but if you're strong in that industry, it usually doesn't stop them entirely. But there are definitely people that sit around and look at the bank's portfolio and say, you know, how is this diversified? Just like in your life, you diversify your portfolio. You don't want to put all your eggs in one basket. They do the same thing. So basically what we're talking about here, and the way the underwriter looks at it is it's called 3 ways out. They're looking at cash flow, collateral, and a personal guarantee. And when I talk here, I'm talking about a small business. I'm not talking about a big business, although in some respects, these factors are also considered by them. But as a business grows and gets older, and the business really is strong on its own, obviously the personal guarantee might be waived. But in a small business, you're still going to be looking at that personal guarantee. So it's cash flow, collateral, and a personal guarantee. And it's not one or the other. It's a combination of these variables that leads to your approvals or your declines. In other words, if you're very strong on cash flow, great collateral, but maybe weak on a personal guarantee, that might be enough to drive an approval. It could be a combination of all 3 or 1 or 2. Typically, if you're only good at one and you have the other 2 are very weak, it's going to be difficult to make that decision. So let's dig into the cash flow. And again, my idea today is not to dig too deep and get into the weeds. You're not going to become an underwriter after this workshop. But I want you to understand a little bit about what cash flow means. First of all, we're going to look at your annual business debt. So the current debt that you have, as well as the new debt that you're taking on, we put that down into monthly payments times 12, and we get an annual business debt. Then there's a thing you may have seen, it's called EBITDA. It's earnings before interest, taxes, depreciation, and amortization. So with EBITDA, we look at your tax return and we look at the net profit and we add back interest, depreciation, and amortization. And people will say, what is depreciation and amortization? Exactly. Well, they're non-cash expenses. And what that means is they are basically expenses that reduce your tax liability, but they're not out of pocket. So if I have a car and I buy it for $30,000 brand new and I drive it off the lot, people always say, yeah, well, then it depreciates immediately. Why? Because you own it, you put your feet in there, and it's now your car, and it's not worth as much as it was when it was sitting on the dealer lot brand new. That's called depreciation. It's a reduction in the value of that asset over time. Amortization is also the same thing, but it's an intangible asset. Think of like a patent that you got or a trademark, maybe your franchise agreement. So your accountant would work on depreciating that investment over time, but that's an intangible. So they're going to try to get your operating profitability together. Like, how much money do you have available to pay your debt? And they're going to perform what's called a debt service coverage ratio.
Excuse me, Willa, before you go, EBITDA, I have interest before, what is the I?
Interest, taxes, depreciation, and amortization.
Interest, taxes, depreciation. Thank you.
The taxes only come into play with a C corporation, typically, but that's why I'm simplifying it here. It is much more complex than what it looks like, but I wanted to give you an idea of what they're looking at. And just to go back to EBITDA, that is why your tax return, it wants to be somewhat healthy. You want to have a net profit. Otherwise, you're kind of behind the 8 ball to begin with if you're showing losses. But anyway, so it's going to be a business debt service coverage ratio is going to be your EBITDA divided by your annual business debt. And it's going to come up with a number. And what does that really mean? What that means is for every dollar in debt or liabilities, there should be $1.25 in money that you have available to pay it. So a debt service coverage ratio should be greater usually than 1.25. So that means the money I have available in my business, I have enough cash flow to pay my debt and then a little more. Now, there are some lenders that might play with that number, might be more comfortable bringing it down, but typically a conservative lender would like to see it over 1.25. Certainly, if I did the numbers on a business and it was 3 times, that they had 3 times as much money available to pay their debt, I would be very happy. You don't want to get it too high because then you're not efficiently using the money coming into the business. Maybe you should be investing some of that money or using it to grow. But that gets into the weeds a little bit. The most important thing is that you should have enough money available based on the net profit on your tax return, adding back interest, depreciation, and amortization on that tax return to cover the annual business debt. Now, I have on here business only and then global. What does global mean? Global means I take your personal side and I look at your expenses on the personal side and the income coming into you personally. And if there's a surplus there, what we sometimes call on the personal side as discretionary income, I can add that back into the business because again, that is mama and dada coming in and helping the baby, right? So I want the business to stand alone. But if it's a newer business, I may have to look on the personal side and add in some of the personal. And where the main question here is, does the cash flow of that business and the people involved in the business, if necessary, support the amount being requested? Now, if your business passes, but globally you're a newer business and that business is what you're relying on to live personally, and you don't have enough money personally to live, and you're counting on a brand new business to support you, and you are looking for money for a business that is purely projections, in other words, no historical look for that business, that's going to be difficult. And that's why a lot of banks and financial institutions are shy away from startups, unless the startup has a very strong personal guarantee where somebody already has another source of income that they can throw towards the business as it's starting to get bigger and better. So it's a common sense thing that you want to make sure that there's enough money there to cover the debt. I mean, it's interesting in our own lives. A lot of people live what they say beyond their means. What does that mean? It means the money coming into my personal life is not enough to cover the expenses that I have. So what do? I use credit cards. I end up getting way over leveraged. I have too much debt against the amount of money coming in. So this calculation is the same calculation we kind of should be doing on the personal side. If we did that to ourselves, how much money is coming in every month? How much do I have to pay out for my mortgage or my rent or my utilities? Or as they say, what personal living expenses, how much does that cost? You know, clothing and food and all of that. Underwriters actually use a formula to figure out what people have on the personal side for those kind of expenses. So this is a big calculation. I'm not going to go further into this because it really does get into the weeds, but I want you to take away the concept of cash flow and why a lot of people get declined because their tax returns are showing losses. Maybe they don't have a lot of interest added back, no depreciation, no amortization. So you can't take on more debt if you can't pay the bills that you have already. So this is a key qualifier, if you will, of those 3 ways out. If there's not enough money coming in to pay the debt, that's going to be a tough thing to mitigate and to overcome. Now, things that come against cash flow is, let's say I own my building and I had to put a new roof on this year, and that is what we call a one-time capital expenditure. So I had to take money out of my cash flow to pay an emergency expense, but that never happened before, or it hardly ever happens. So that would be something an underwriter should know about, so that they can add that back in and help your cash flow. So it's an equation that has a lot of moving parts, but basically it's money in, money out. They just want to make sure you have a little cushion there of the money coming into the business against the money going out. I'll let you digest that for a minute. It's a big one. The second thing we're going to talk about is collateral. So that's, most people understand this, right? Because you buy your home, that's collateral for the loan, and the lender is going to look at your down payment against the loan. And if you're putting 10% down, the loan to value is 90%. If you put more down, the loan to value decreases. So if I put 50% down, my loan to value is 50%, right? So the bank is putting in 50 and I'm putting in 50, and banks love that. They love low loan to values on real estate. That also, with a business, there are loan to values on other assets. One thing is accounts receivable. You will see on a profit and loss statement up at the top, right below cash, is accounts receivable. What is that? That is money that you have invoiced to people you've done business with, and you're waiting for them to pay you. Typically, people pay in 30 to 45 days, just like you pay your monthly credit card bill or any bills that you get. They have a due date of when you have to pay the bill. When you get beyond 90 days past due, it starts to become what we call uncollectible. So when an underwriter looks at accounts receivable, they're going to ask for an accounts receivable aging report, which tells me how long have you been waiting for that money from Leslie. And if Leslie hasn't paid you and there's a portion of that money that is over 90 days, I'm going to disregard that. And I'm only going to take 80% of the total amount of accounts receivable under 90 days. It makes sense when you think about it. I've seen businesses where they have huge amounts over 90 days. And when you ask them, you know, what are you doing about all this money that's owed to you? And you're still selling to that person. It makes people wonder that if you're really on top of your collections. You know, it's hard. It's hard to ask people for money sometimes, but if you did the service and you want to be paid, when you first take on a customer, that's why people will say, I need you to pay me 50% down in cash at the start of my construction project with you. And then you pay in increments after that. The reason they do that is they want to see if you're going to actually pay your bills with them. And they don't want anybody to become really past due like that, where they have to send it out to a collection agency and only get a certain amount of it back. So it is an asset that they consider as a collateral for a loan, but not the entire amount. Inventory is another tricky one that it's reported as an asset on your balance sheet, but sometimes I might want to look at the detail of that inventory to see how long you've held that inventory, what turnover you have in your inventory, and the quality of the inventory. I had a client once that sold bike parts, and he had things in there that were 40 years old. And he said, well, you know, there are still people that have bikes that are 40 years old. True. But, you know, do you need 30 of those parts or 10 of those parts? I don't know. And what's happening is those parts are taking up a lot of space where you could be putting new inventory. So it's a cost benefit analysis with inventory. So typically they will value about 50% of that inventory, because again, if you're holding it for a long time and you have to sell it, it's not easy to sell if it starts to become discontinued or old, or in the food world, it goes bad, right? So inventory is typically valued at about 50% of what you see on the balance sheet. And then there's equipment and there's real estate. And again, if you're buying equipment or you're buying real estate, we're back to how much are you putting in and how much is the bank putting in? And it depends on the equipment and it depends on the real estate, whether some of the mitigants could be it's in demand. Maybe the real estate, you're going to put improvements in it. So they're going to do an appraisal as completed. So they get an idea of the value of that property after you put the improvements in, and they'll base the loan to value on that. So there's lots of factors involved, but it is the collateral is the security behind the loan. And there often are what we call shortfalls, which means there isn't enough collateral to support the loan. And then they're going to look at mitigating factors. What are those mitigating factors? Well, one of them is a personal guarantee. How strong is that personal guarantee? Do you have other assets in your life that could be used? The SBA, for instance, requires that if a person has a home and there is a shortfall in collateral on the loan, they will put a lien on the home. Doesn't mean they're coming after your home, but it does make them feel better about doing the deal. Because again, it's ways out. If this loan goes into default, how do I get my money back? That's all they're asking. Does the collateral support the amount being requested? If the loan goes into default and I have to liquidate everything that the owner has, what am I going to get back? They're protecting their investment. The one thing I didn't talk about was the UCC1 lien on all business assets. And this is a very common thing that you see. A lot of the disaster relief programs have had this. And this is basically a blanket lien on the business, meaning everything that the business owns is thrown into this pool. And hopefully if you go out of business and you liquidate, maybe the lender can come in and retrieve some money. You should also know that there are positions that lenders take. So if just like on your home, if I have a first mortgage and then I get a home equity loan, the bank that does the home equity loan is in second position and the first mortgage is in first position. What do you think is better? The first position, right? So most banks want to be in first position. So they will pull a listing of all of the liens on the business and see where they stand. They'll do a title search on the real estate to see how things are going. They also do environmental reports on commercial real estate to see if there's any past businesses that occupied the property that maybe dumped oil on the property or were dirty businesses, and there's going to be issues with that where you're going to have to remediate the property before you purchase it. So it sounds terrible, but in a way it's protecting you as well, because you want the property to be clean, you want to be able to sell that property again. So commercial real estate does do this extra due diligence on those properties because you have a lot of different owners and a lot of different people occupying the property, and they want to see what is going on in the past that could impact, create a lawsuit. If there was a printing shop on the property and they dumped a lot of printing materials in the property, it could affect the water supply. People could live there at some point and create drama. And that the bank doesn't want to buy a property that has that kind of a reputation. So they're going to want that cleaned up before the property closes. Okay, so that's collateral. And the last one is your personal guarantee. Again, liquid and illiquid. What do you have available right now that you could use to pay your debt? And what would you have to sell in order to pay your debt? What is the propensity of you to provide funds for the business when needed? What surplus do you have? What's your skin in the game? When I talk about personal guarantees with people, they're like, oh, I don't want to give a personal guarantee. And right away, it makes me feel that they're not standing behind their business. I understand it in a way because people don't want to lose everything they have in life to the business. But in a way, when you first own a business, the business is you. There's no separation. You are putting the money in. Again, back to that child and that parent, you're giving it everything you can. You have skin in the game when you have that child, right? I mean, nobody's walking in and taking care of your kid. You're taking care of the kid. So it's the same thing in business. You have to stand behind the business, make it your own business with the expectation that someday it's going to have a return for you and be able to pay for its own way. So your personal credit score and your repayment history are very important. Trends have shown that people who own businesses who have terrible credit, the business has terrible credit. Why? Because we kind of treat credit, it's a behavior that we learn very young in life, and it's kind of in our bones, if you will. Some people get very upset when they're behind on their payments. Other people can carry bad, go 3 or 4 months. Back to that accounts receivable, they just don't think about it. They don't care. They don't pay back. And lenders are always going to look for people with good repayment histories on the personal side as well as the business side. So we're going to look at how much support does and can the guarantor provide. Quickly, impacting the credit score, history of repaying money you borrowed, the types of loans you've had, how long you've had a particular line of credit or a loan, and how much total debt you owe versus what is available to you. These are the things that go into a credit report. We all know credit is very important. There is a free annual credit report from annualcreditreport.com. This is federally sponsored. And you should know that during the pandemic, they have offered, the main ones are Equifax, Experian, and TransUnion. And through annualcreditreport.com, you can get a free weekly report, which will not impact your credit score through April of 2022. So this is just for the pandemic. They were trying to help people restore their credit, get on top of what they owe. And I think that everybody should make a regular check of their credit report. What you'll get is a report. You may have to pay a little extra to get the score, but the report is what the underwriter uses because it tells her exactly what the minimum payments are on everything that you have, and it gives her a good view of slow pays, any collections, things that may impact you with a bank, charge-offs, things like that, bankruptcies. All of that is going to show up on your credit report. So it's very important to keep very good credit if you want to be bankable and you want to get money in life. So this is a summary of the 5 C's of credit, which you may have heard of. It's kind of an abbreviation of everything I've just talked about, which is what most people say you need to get money in life, which is good credit. That's the most critical. Your owner investments into what you have at risk if the business fails. Your collateral, which we just talked about, conditions, which is very important right now. We're in the middle of this pandemic. We haven't come back completely. So obviously there's a lot of uncertainty, which always makes lenders nervous. And then, of course, the character, which back to those bankers, the general impression and your relationships with these key partners is very important. If you're in the bank on a regular basis, hi, how are you? You've got your deposits there, you're growing with them. They get a good impression of you as a member of the community. You're a part of the Chamber of Commerce. Everybody knows who you are. People love your business. These are good impressions of borrowers that really do feed into positive results. So let's talk quickly about what gives you an overall positive impact. The number of years in business. Obviously, the longer you're in business, the easier it is to get financing. The earlier you're in business, people are going to want to see your resume, your experience. Why should they trust you to be able to run this business effectively? The amount of deposit balances at your lending bank. One of the first things you should do is get a relationship with the bank and start putting money in there so that you can point to that when you come up for important purchases that you want to make and you want their help with. Strong sales revenue. Some people look at their revenue and they don't even know what it is. And you should see year over year, you should see growth. They always say if your business isn't growing, it's dying. It's very important to try to keep revenue strong. Again, we just had a bad year. A lot of revenue went down. That's expected. Everybody knows why. But typically a business does better year over year, or they have a good explanation for why they didn't. Strong credit bureau score. Collateral we talked about, and then we're going to talk about what has a negative impact. The amount of debt against, again, how much money you have coming into your life and how much assets you have. If you're asking for a lot of credit, you're putting in applications at lots of lenders, that's going to show up on your credit report, and it makes them very nervous. It makes you look a little desperate. So that's why we try to focus on getting a really good package together and try to focus on going to a bank that you have a relationship with, that knows you, and instead of shopping around lots of lenders at one time. Prior bank charge-offs, if let's say you have a relationship with Citibank and you didn't pay them back for something and they had to charge you off, don't go back to Citibank. They are not going to do your deal. By the way, that would also turn off other banks because it looks like you're not somebody who stands behind what they take. So if you're delinquent, you've got a lot of slow pays, that's going to be having a negative impact. Anything on the credit bureau that shows delinquencies or that you haven't paid in many, many years. Now, again, there may be explanations. Maybe you're going through a divorce, everything got frozen for a while, but you were always stellar before that, and you're getting better now. That might be the mitigating factor. There are what they call high-risk properties and industries. And we can probably think about what would make an industry high risk. Basically, it's industries that are not as favorable. For instance, SBA actually has a whole list of high-risk industries. Right now, probably marijuana sales might be in there, even though it's legal in New York, it's not federally legal, so that might be high risk. At this time, it might change. Some properties are located in bad areas, or they just they have lots of environmental concerns. Maybe things in the past done at the property were not good, so they might be considered high risk. There's lots of reasons why. If you are a higher risk, you can still get a loan sometimes, but your rate will be higher, and sometimes your loan repayment might be shorter. So that will be a way of doing mitigating against that. And of course, business losses. If you're showing losses year over year over year, and people will say, well, that's only because I don't want to pay taxes. Yeah, but again, that's the Bible on your business. So if you are showing losses as a strategy, then you are going to be self-funding your growth. So if you're putting money aside and you don't want to show that to the government because you don't want to pay taxes, that's okay. That's your strategy. But then when you need money for growth, that money you put aside is what you're going to end up using, because they're going to look at what's on those tax returns as an indicator of the positive nature of your business. I didn't think we shouldn't end the workshop without talking about online lending, because during the pandemic, a lot of online lenders made a lot of money with all of the PPP programs, and they've introduced themselves to our world more than they ever had before. So there are some benefits to online applications. They have very quick turnarounds. Their funding sometimes is usually within a week. They will accept people with less than perfect personal credit, maybe anything over 500, whereas a regular lender would be over 670 usually. Sometimes they'll do startups or at least low time in business. Some feature no collateral requirements, and you can sometimes quickly compare several loan offers all at once with an online lender, which makes it like shopping online. The downside. Sometimes they want their money back very quickly. They don't take risk. Again, if there's a high risk, they're going to want this to be paid back quickly. They don't want to invest in you for a long period of time. So there would be a high cost of capital, high origination fees, meaning the fees to get the loan would be high. The annual percentage rate on your interest can range from 9% to 80%. And I'm not making that up. There are some out there. Typically, they will actually take the payment directly from the checking account, and those would be either daily or weekly payment deductions. Not all the time, sometimes it'll be monthly, but they're going to want to pull directly. And of course, there are online security concerns, which we all know about that. We caution you to be safe. Protect yourself from predatory lenders by looking for these warning signs: unfair and abusive terms, deception, coercion, significantly higher interest rates, fees that are more than 5% of the loan. And you really should look at the annual percentage rate, which has all the fees built into it and gives you the true picture of the rate you're paying and your full payment schedule. Please don't lie on paperwork or leave signature boxes blank. That invites fraud. And also, all the lies will get proven out. All your information is really out there. So they're going to verify it. And if you're lying, it's not going to look good for you. And don't get pressured into taking a loan. Again, the main point here is to give you a view of underwriting. It's not a punitive process. Lenders want to make loans. Banks want to make loans. They just want to be careful about the loans that they make. And you should also be careful about the loans that you take. So they are there to partner with you and to help you make that decision, and if you have to step away from taking a loan because you found out through the underwriting process that things didn't pan out the way they would have, or you didn't get the loan, you should really take a second look at what you're doing, and maybe the timing isn't right. Maybe you need to make yourself stronger and do it next year or the year after. Some final thoughts from me. Passion. Passion is something I love. It's all about entrepreneurs. I mean, they're just so much fun. They believe in what they're doing. They want to do it. They know it's going to work. But if you're going to get money from a bank, it has to be supported by the facts that we talked about here today. The passion has to come through. I want to feel good about the money that I'm giving to a borrower. I want to feel their confidence. I want to see that they've done stuff before that brought them to this point and they're ready for it. That is so important. It's a big factor, but more important to an underwriter is what the numbers tell them. So they're going to look at you honestly and look at you realistically. So just beware that it's not all about just telling people that it can happen. It's showing people that you have what it takes to make it happen. Complete loan packages, rule of the day. If there's one message I get across today, it's that putting a beautiful loan package together makes underwriters smile and they love you immediately. I used to love getting the package together and the first day, like doing all the spreads and going, oh, this looks good. This looks good. This is going to work. Or I reach out and I get my questions answered right away. So it's really an important thing to present a good first impression. Declines, again, can be a good thing. They really can. I know people hate them and it's really a bummer when you get it, but it's something you want to think about. There may be alternatives to a decline from a bank. The banks nowadays, especially the big banks, the commercial banks, they have a lot of opportunity and they're probably going to be looking for the cream of the crop deals. So you may want to look at a community bank or a community financial development institution, sometimes even an online lender. But again, look at why you're being declined and see if there's something there that makes sense, and maybe it makes sense not to move forward. We at the Small Business Development Center are here to hopefully protect your investment, because you will be putting money into a business. It's not going to be all 100% supported by a bank. So when you're putting money into something, you want to look at it very carefully and do your due diligence, just like the underwriter. And the last thing is relationships still matter. We are very much online and very much into our computers, but your handshakes and your smiles when you go into banks and get them to know you and love your business really do matter when you come down to lending. It does matter to have these relationships and to build them over time so that when you have those big bucket list items that come your way, you're going to have a chance at getting the dream that comes true. If anybody has any questions or concerns, we'd love to meet with you individually and talk further about your particular situation. It's a difficult thing to talk about, get into the weeds with people on their particular situations when we're on a big group call like this with everybody on the line listening in. So if you put in the chat box, Leslie will set up an appointment with you to either meet with me or another advisor here. I hope that you've learned a lot about the mind of the underwriter and what they look at. It's really a bird's eye view, but it's the tip of the iceberg. They do a deep dive into what you're looking to do. And I really want you to know, because I was a commercial lender and I still think like one. I want you to know that they do want to help the businesses that come in the door and are looking for money. It's not that they're not trying to help. They want to do the deal, but they do have to look at the big picture and see whether it makes sense. And again, they are conservative. They're not really people that are going to take a lot of risk. But I've seen a lot of deals get done that didn't meet all the boxes, but that had a lot of potential and people were reasonable and logical about it and deals got done. So I don't want to give you the impression that it's just all a big decline. It isn't. A lot of people get approved. A lot of people move forward. The SBA is also a great partner with the banks to help them do the riskier deals that come their way. They have a little bit more lenient debt service coverage ratios, collateral requirements. They allow you to put 10% down when you're buying a building. So they are there as partners to help banks feel more comfortable moving businesses forward and developing businesses in the community. So it's been a pleasure talking with all of you today. I see we have a lot of people on the call. That's great. I hope you picked up some good information, and please let us know if we can help you further. Leslie, you're on the call too. And Leslie is our front desk manager, and she's like the heartbeat of our Small Business Development Center. And she'll set you up to make sure that you get follow-up information. And thank you very much for attending today. We appreciate it. Okay. Leslie, I can't hear you. You're on mute.
Yeah, that's me. I'm going to stop recording at this point.
Okay.
Okay.